Welcome to Sus Crypto, your YouTube channel that looks at crypto through a speculative lens. Hi, I'm Liam, and I'll be showing you how I deal with a speculative crypto market in a calculated way so that you have a better chance of winning the big game. I currently use an algorithm that I've developed to provide buy, hold, and sell signals to automate my decision-making process. Hopefully, by seeing my approach play itself out, you can develop a system for yourself. You're probably here because of all the hype around cryptocurrencies and a fear of missing out. We all would love to shed the chains of our daily jobs and do what we want in life. It would be great to pay off that insane mortgage, or even buy a house to begin with. Maybe travel several times a year, or spend more time on causes that are meaningful to you. Or maybe even buy a concert ticket without worrying. Everywhere you look, crypto has become the shiny new investment where people are betting large to live that millionaire lifestyle. It's hard to browse around without seeing the crypto prophets pushing the buy now narrative with dramatic headlines. You can't miss them. Their message can be persuasive. Blockchain technology is amazing. In time, it will revolutionize the world. The issue is that these crystal ballers always ask you to buy, or even buy and hold. This is the investment game. When was the last time you saw the headlines telling you to sell? As Bitcoin was heading towards 60,000, most prophets were saying, buy more. Many got out in time, but many didn't. But then again, we've seen this all before. Why should crypto be any different? The mainstream financial networks covering the adult stock markets will always hype the next great stock and the newest reason to buy it. In fact, I just heard a pundit on a reputable network telling the retail investor to buy a stock for a company where a small part of its business was involved in prepackaging French fries. Toting that, get this, that the fry attachment ratio for fast food chains has been going up. I guess there's always some positive spin to get you to invest. Rinse and repeat. Following this so-called advice will turn any investment into pure speculation. To be somewhat successful in the stock markets, you or your advisor need to personally analyze the company's financials, their markets, and the company leadership. When it comes to the crypto market, the lack of company financials, coins created without a market problem to solve to begin with, and the misdeeds of company CEOs has made crypto a truly speculative venture. What to do? Most of us still have that itch we need to scratch without risking our nest egg. Speculating on something more than just a lottery ticket or a football pool requires some financial guardrails. I test my venture against these 4 rules to keep me on track. Rule number 1 is change your mindset. Don't consider what you are doing as investing. Consider it as a commitment to money, a bet, on something that you believe has a tremendous upside. Set aside a fixed amount of money that you'll never top up. Although not what we're hoping for, it's okay if the entire bet goes up in smoke. Consider it the cost of scratching that itch. Also, don't put all of your money into one bet. That way you always have something to play with. Does the bet meet a minimum upside? Consider your venture and come up with a realistic ballpark of the return on the bet. For me, the upside has to be much better than putting the money into the bank or the stock market. The upside has to be at least 4 times the original commitment, but you can choose any multiplier that satisfies you. For those who want to see the math, 4 times the original commitment is based on getting 10 times the value of putting my money into a corporate bond or stock market. As an example, if I'm committing $100 to a venture, the minimum upside would need to be $400 in addition to the $100 originally committed. If it's below your threshold, don't commit. Know your odds. In my mind, the chance of a favorable outcome must be better than a coin flip. Let's take the crypto market as an example. There are over 20,000 coins in the market. However, if we look at larger coins with a market cap of 100 million or more, there are about 180 coins you can choose from. So, what are the chances of you buying and holding the coin that will outperform the rest? About 0.5%. Even if you buy 25 coins, the odds increase slightly to 14%. Not good and a lot worse than a coin flip. And rule number 4, be patient. There will always be influencers telling you to do something else. Set yourself a reasonable time period to review how your venture is going. At a specific time, evaluate and then either pull a plug or continue. This will keep you from getting frustrated if the results are not immediate. Once you commit to a venture, consider these last 2 rules. Make winning a bet worth it. If your bet comes through, take a portion of your winnings and put it towards the important parts of your life. Add it to your down payment fund or go buy those concert tickets. And finally, don't let rule number 5 get to your head. Don't let an early win or even a couple of wins convince you that you now have a new way of investing. Keep your itch from becoming the hives. So let's look closer at my trading algorithm. I started with my investments in the adult stock markets, such as the TSX and the S&P 500. I tried to find sources, conditions, and events to determine not only when to buy stocks and ETFs, but also when not to buy and when to sell. Once I found the correlating conditions and events, I developed the algorithm to take the emotion out of investing. The algorithm uses these correlations to create triggers to tell me when to buy, sell, or hold. I've backtested the data through 3 recessions and began using it a few years ago. It produces both positive and negative transactions. However, the positives outweigh the negatives in both number and size. In general, the balance goes up. I recently looked at applying my algorithm to the crypto markets, and to my satisfaction, it performed well. Actually, very well, thanks to the huge rally. Will this happen again? Well, yes, if you ask the influencers, but really, no one knows. To date, I've developed 5 triggers for 5 different cryptocurrencies. Today I am sharing the performance of Chainlink to provide you an understanding of the algorithm. Here is an historical view of the transactions made since 2017. Shaded areas indicate that Linkcoin is being held. Unshaded areas indicate that a stablecoin is being held. A trigger calculation determines when each of the transactions occur. But is this venture worthwhile? I'll use my 4 rules as a template for my explanation. Rule number 1, change your mindset. This algorithm is not investing. It simply allows me to place bets in a speculative crypto market. I'm committing $1,000 to this venture and have accepted the fact that I may lose it. Rule number 2, what is the upside? I calculated the upside by backtesting the algorithm starting in November 2017. The results indicate that a $1,000 commitment yields a return of over $565,000 today, excluding gas fees. This represents a 560 times performance and definitely exceeds my 4 times threshold. Wow, seems too good to be true. That's what I thought. I wondered how the manic buying in the late 2020 bull run affected the performance. So let's take a closer look. What happens to the performance if we happened instead to make the initial $1,000 commitment in later years? Note that commitments made from 2017 to 2019 had both the benefit of time to make transactions and a full market cycle both up and down. Commitments made in 2020 and 2021 involved a partial cycle, where purchases are made during the bull cycle and then riding out the bear cycle. The returns changed dramatically. Overall, the average profit multiplier was 135 times. Since large numbers can skew average results, I considered the median performance at 14 times, which still exceeds my 4 times threshold. Rule number 3, the chance of a favorable outcome must be better than a coin flip. The algorithm exceeds my 4 times threshold on 3 out of the 5 data points above, and had a positive return 4 out of 5 times. To me, that's better than a coin flip. Rule number 4, patience. My tolerance is limited to about 1 year. During this time, I would expect to see some activity that allows me to assess the viability of the venture. I'm not going to wait around forever for some event to happen. Looking at the backtest data, there have been 58 transactions in a span of about 5 years. This works out to about 1 transaction every 37 days. However, the time between transactions varies dramatically. It has been as short as 2 days during the bull run and as long as 88 days when the markets were trading sideways. Overall, this meets my patience threshold. But this also tells me that this may be a long race to the finish line, and that I need to monitor the algorithm daily so that I don't miss a transaction trigger. With all 4 conditions met, I've made the commitment, and I'm actively monitoring the algorithm. I'll be posting the results daily to this channel so that you could follow along. The updates are literally less than a minute long, and they will give you some insight into the market direction. Subscribe for quick access. If the subscription pool indicates a large enough following, I will begin posting daily performances for other cryptocurrencies. Let me know what currencies you would like to see. And hit the like button if you've enjoyed this video. Play smart, and thanks for watching.